Hello students, this is Dr. Chetna Kumawat. In today's lecture, we will understand the difference between cash flow statement and funds flow statement, difference between cash flow statement and income statement, difference between cash flow statement and cash budget, and some other important terminology. So let's begin with the difference between cash flow statement and funds flow statement. We will take point by point. Point number 1, meaning of funds. In cash flow statements, funds means only cash, which is a component of net current asset. In funds flow statement, funds means net working capital. Objective. Objective of cash flow statement is to know about the changes occurred in cash position between two balance sheet dates. The objective of funds flow statement is to know about the changes occurred in net working capital between two balance sheet dates. Basis of preparation. Increase in current liabilities or decrease in current assets except cash results in an increase in cash or vice versa in cash flow statement, while increase in current liability or decrease in current asset results in a decrease in net working capital or vice versa in the funds flow statement. Effect of transaction. In cash flow statement, effect of a transaction on cash is considered, while in funds flow statement, effect of a transaction on net working capital is considered. Utility. Cash flow statement is useful for short-term analysis, while funds flow statement is more useful for long-term analysis. Statement of changes in working capital. No such statement, while a separate statement for changes in working capital is prepared in funds flow analysis. Cash balance. Opening and closing balances of cash are shown in cash flow statement. Such balances of cash are shown in a statement of changes in working capital when we talk about funds flow statement. So this was difference between cash flow statement and funds flow statement. Let's take a look on difference between cash flow statement and income statement point by point. Number 1. Objective. The objective of cash flow statement is to know about the inflows and outflows of cash during an accounting period, while the objective of preparing an income statement is to know how the income was earned during the accounting period. Nature. Cash flow statement is a statement of changes in cash, that is how the cash was generated and how that cash was used during a given period, while income statement shows net profit or net loss for a given period. Scope. Cash flow statement presents information only about cash and cash equivalents, and its scope is limited, while income statement presents the result of all business transactions on income of the business entity for the year. Therefore, its scope is wide. Basic information. Cash flow statement is prepared for comparative balance sheet, income statement of the current year and additional information, while income statement is prepared from nominal accounts and additional information in the form of adjustments. Accounting basis. Cash flow statement is prepared on cash basis of accounts, while income statement is prepared on accrual basis of account. So this was it for the difference between cash flow statement and income statement. Now let's understand difference between cash flow statement and cash budget. There is an important relationship between cash flow statement and cash budget. Both explain the changes in the cash balance, but however, it is to be remembered that cash flow statement is not a statement of receipts and payments of cash. It is an explanation of the effects of different business events on the cash. But cash budget records all planned cash receipts and cash payments. Gray and Johnson specify the following differences between the two. A cash flow statement is roughly a report of cash activities of past period. However, it is possible to prepare a projected cash flow statement, but a cash budget is always prepared for future period. B. Usually, a cash flow statement covers a period of 1 year, whereas the cash budget is broken into monthly, weekly segments. C. A cash budget emphasis on the financial pattern to meet seasonal or temporary cash needs. A cash flow statement does not emphasize on particular source and uses. D. A cash flow statement is less detailed than a cash budget. Thus, cash budget is a technique of future financial forecasting, while cash flow statement is a technique of past analysis. So, now we have a clear understanding of the differences between cash flow and other items like funds flow statement, income statement, and cash budget. So now let's understand the treatment of some special items. In addition to the general classification of these type of cash flows, AS3 has also provided for the treatment of cash flows from some special items as discussed further. Interest and dividends. Cash flows from interest and dividends received and paid should be disclosed separately. Further, the total amount of interest paid during the period should be disclosed in cash flow statement, whether it has been recognized as an expense in the income statement or capitalized in accordance with AS 10. The treatment of interest and dividends received and paid depends upon the nature of the enterprise, that is financial enterprise and other enterprise. AS3 provides as follows. In the case of financial enterprise, cash flow arising from interest paid and interest and dividend received should be classified as cash flow from operating activities. Dividends paid should be classified as cash flows from financing activities. Other enterprises. In case of other enterprises, cash flow arising from interest and dividends paid should be classified as cash flows from financing activities, while interest and dividends received should be classified as cash flows from investing activities. Taxes on income. Taxes paid are usually classified as cash flows from operating activities. However, when it is practicable to identify the tax cash flow with investing or financing activities, the tax cash flow may be appropriately classified as an investing or financing activity, and the total amount of tax paid is disclosed. For example, a building is sold for rupees 10 lakh and the company has to pay capital gain tax of rupees 1.5 lakh. In this case, the payment of tax is clearly identifiable with the investing activities. Therefore, the payment of capital gain tax will from part of cash flows from investing activities. Foreign currency cash flows. Cash flows arising from transaction in a foreign currency should be recorded by converting the foreign currency amount at the exchange rate between the two countries at the date of cash flows. Unrealized gains and losses arising from changes in foreign exchange rates are not cash flows. However, the effect of exchange rate changes on cash and cash equivalents held or due in foreign currency is reported in the cash flow statement in order to reconcile cash and cash equivalents at the beginning and the end of the period. This amount be disclosed separately from cash flows from operating, investing, and financing activities. Extraordinary items. The cash flows associated with extraordinary items such as bad debts recovered, claims from insurance companies, winning of a lottery or a lawsuit, etc., are disclosed separately as arising from operating, investing, and financing activities. Significant non-cash transactions. Some investing and financing activities do not require the use of cash and cash equivalents. Example are purchase of assets by issue of debentures, purchase of business by issue of shares and debentures, conversion of debentures into shares, issue of bonus shares, etc. These non-cash and non-cash equivalents should be excluded from a cash flow statement but should be disclosed in a separate schedule by way of a note. So this was it for today's lecture. Thank you for your patience and listening.